All right, welcome to video number 2 of Guide to M&A Transactions. So in this video, we're going to be discussing how to actually value an M&A transaction. When you're buying a company, how do you know how much to pay? It's a difficult question, really. If you're buying a listed company, the price is fairly straightforward because it's based off, usually, the trading price of the company. So it's a very liquid, you're told the price of the company at any minute of any given day of what the market's willing to pay, but it gets a little bit trickier with private transactions. So we're going to talk about 2 ways of valuing a company. Now, I guess there's a couple of points here. Number 1 is differentiating between what is value and what is price. So price is what you pay for the company, but value is what it's worth. And sometimes the market can distort one or the others. For example, during the 2000 stock bubble, the price of companies became much higher than the value of companies, and over time that corrected. Now, throughout history, there are periods where companies are overvalued, undervalued, which essentially means the price being asked or quoted in a liquid public market is higher than the value that you receive for a company. So when you're structuring a transaction, you want to have a value of the business internally, so you know what it's worth, fair value, and then you want to negotiate the price. And typically that price comes in around the value of the company. Typically there's not a huge amount of difference, but on occasion you will be able to find a good value deal. So how do we value a business? So there's 2 ways of valuing a business. And what this essentially calculates is, when we say value of a business, we talk about first and foremost the enterprise value of a business or equity value of a business. And we'll talk about what the difference between those are a little bit later. But for now, let's talk about in broad terms, so what is the value of a business? So there's 2 ways of valuing a business. Number 1 is based on a discount of future cash flows. So what this is essentially, it's all of the future cash flows of a particular business, essentially into perpetuity. And $1 today is worth more than $1 tomorrow. So essentially what we do is we discount all of those future cash flows. So what that means is, as you start going 5 years into the future, 10 years into the future, the value of those cash flows start to get lower and lower and lower because they're further away, and you have things like inflation, interest, and uncertainty and risk, etc. So how do we do this? So we essentially build a model. We build a DCF model, is what it's called, discounted cash flow model. And what that is we essentially model out the P&L of the business. So we go from revenue all the way down to EBITDA. So EBITDA is a proxy for earnings of the company, but it's different to net profit of a company. So net profit is a very inclusive term. It includes lots of things that aren't included in EBITDA, for example, depreciation, interest, but we'll talk about that a little bit later. But EBITDA is the universal proxy for the earnings of a business. So essentially we model out the profit and loss of the company all the way down to EBITDA for maybe 3 historical years, sometimes more, sometimes less, but we need a bit of a run rate of historical, because that then forms the basis of our future forecast. This is our modeling assumption. And this is where there's a lot of judgment involved and a lot of risks to actually value it the wrong way, because you could have an inherent bias and say, okay, we're expecting 10% a year revenue growth, and model it out and value the business. Obviously, the value is going to be higher than if the revenue growth came in lower than that. So we just need to keep that in mind. And a good way to kind of reference check our assumptions is to talk to management, talk to the various stakeholders in the business, and also compare it against different other ways of valuing the business. Because if you've got a very large discrepancy between different ways of valuing the business, then maybe you've gotten one of them wrong. And the one you've gotten wrong is probably the DCF, the discounted cash flow, simply because the level of professional judgment required to calculate that. And then we get to the EV, or our headline price. So we essentially model out all of our future cash flows into the future, discount it back, and the present value of those cash flows is our enterprise value. Now that's one way of valuing a business. However, the more common way that companies model a business is typically with the second method, and this is the price earnings or PE multiple. Now, we've used price earnings here, but it could be it could be various different multiples, and we'll go through what some of those multiples are a little bit later. So, for example, EBITDA multiple, net profit multiple, or even revenue multiple, depending on the type of industry and the maturity of the business, will depend on what kind of multiple we'll use for valuing the business. For example, tech companies with no profits because they're scaling rapidly typically use a multiple of revenue. However, the default multiple to use for any given company without necessarily knowing what its size is, what industry it's in, the majority of companies and people valuing companies use the EBITDA multiple. So, how do we calculate that? Well, first of all, we need underlying EBITDA. And what that is it's not necessarily EBITDA for the last 12 months, although it could be. It could be an EBITDA average over the last few years. It could be an average last 6 months actual EBITDA plus forecast EBITDA. But the crux of this principle is we want to identify what sustainable EBITDA is. So typically the way we do that is we look at the last 12 months of EBITDA and then we normalize it. And the reason we normalize it is we take out non-recurring items, for example, potential cost synergies. We need to look at the EBITDA and figure out what it would be for us if we were to buy the company and operate it for the next 12 months. What would that EBITDA be? So again, there's another kind of risk here, similar to how we had with modeling assumptions in that, and particularly with if you're buying a business off a broker or an investment bank, their incentive, because their fee is based on a percentage of enterprise value, they're trying to drive up the price as high as possible. The risk here is that they've made EBITDA seem a lot higher, what sustainable EBITDA to be a lot higher than it actually ends up being. So we need to be really careful, really do our due diligence here and understand what we think underlying and sustainable EBITDA is. There's a lot of businesses that have been purchased on high EBITDAs, and those synergies or cost savings or non-recurring items haven't eventuated, and it's actually blown out the multiple and the EV that they would have paid. So the next component of the factor is the multiple, right? So it says PE multiple here, but as we're using EBITDA, the correct terminology is actually EV multiple, earnings, or EBITDA over EV, so enterprise over enterprise value multiple. Right, but it depends on kind of what metric we're using. As I said before, it could be sales for the first part and then multiple of sales to get to your EV. But typically, the standard approach is to take underlying sustainable EBITDA times your EBITDA multiple, EV multiple, equals your EV, equals your headline price. So if you're doing a large deal, typically you'll do both methods just to kind of sense check both of them. But the basis you use for your primary valuation will typically be the second one, so your earnings multiple. So as you can see down here, the underlying EBITDA of the business is key to both methods. Why is that so important? Well, for the first one, because it forms the basis of our assumptions going forward. If our EBITDA is too high, we're going to overvalue the business in the DCF. Similarly with the second one, if our EBITDA is too high, if there's too many kind of unrealistic normalizations, or perhaps we've taken out non-recurring items which aren't actually non-recurring, the risk is we'll overinflate EV. So we need to be very careful about selecting the right EV. Okay, so how do we calculate the rest of the purchase price? So all we've talked about so far is EV, or headline price, that's the terminology. But how do we actually calculate the end dollar amount, the final dollar amount that we actually pay? So in almost all transactions, it follows a very similar structure in that we start off with headline price and we do our price adjustments and any other matters, and that gets us to our net purchase price, which is the ultimate amount of money that we end up paying. So let's talk about each of these kind of three categories: headline, price adjustments, other matters, one by one. So the first one is headline price. That's fairly straightforward. So typically either done in one of the two methods we talked about earlier, which is earnings multiple DCF, usually the earnings multiple. That gets you to your headline price. So let's take an example. Let's say EBITDA for a business we're looking at is 10 million, and the comparable multiple we're using, we'll talk about how we actually get that multiple a little bit later, is 10 times EBITDA. That means our enterprise value or headline purchase price is going to be 10 million times 10 equals $100 million. So the first number we're starting off with is $100 million, and we'll of course check that with a DCF analysis, which we'll cover later in the course, how to actually do modeling, etc. So we've got our 100 million headline price. Is that the final amount we pay? No, because typically what we'll do is we'll go through and adjust for, in the completion mechanism, net debt and cash, and potentially any working capital adjustment or Capex. Now, why do we adjust for these things? So first of all, net debt cash. So a really important rule in M&A and acquisitions is that when we buy businesses, we buy it debt-free and cash-free. So why do we do that? The reason is you might have two identical businesses, one both with an EBITDA of 10 million and both trading at a multiple of 10 times EBITDA, right? So both worth $100 million. However, one has $20 million of debt on its balance sheet and the other has $0 of debt on its balance sheet. So do you think both of those businesses should be valued the same? The answer is no, because the one with no debt on its balance sheet should be worth more than the one with debt on its balance sheet, right? Why is that? Because, well, debt, we have to pay that back, don't we? So it's a reduction to the purchase price, really. So that's why. And the inverse is true for cash, right? So typically what will happen in a transaction is the previous sellers, or vendors as we call them, will remove cash from the business, right? If they have a same principle of price, right? If they've got two businesses exactly the same, but one's got $20 million of cash on its balance sheet and the other's got $0 of cash on its balance sheet, obviously the one with cash on it, assuming you inherit that cash, is worth more. So what vendors will do, and this is preferred by both sides typically, is that the vendor will actually they'll pay out a dividend and extract cash from the business rather than leave it in for the next seller. Although there are some situations where it's actually a tax incentive, or it's better to leave that cash in for the seller because they can take advantage of capital gains tax incentives. So it might be more favorable for them to leave it in. So it's kind of you might negotiate where it's okay to leave cash in, and you actually adjust it through the working capital adjustment, which we'll talk through in a moment. But that's the general principle for net debt and cash. So essentially we'll increase the value of the business for any cash left in the business that's not taken out, and we'll reduce the value of the business for any net debt in the business that's not, paid down before settlement. But typically the principle is we're valuing and we're buying businesses on a debt-free and cash-free basis. As I mentioned, it's not always possible, or practical to just remove the debt and cash from the business. For example, you might have cash tied up in the business which you need to operate, i.e. working capital requirement, which we'll touch on in a moment. Or with debt, there might be kind of early repayment penalties which are quite cumbersome, and they might say, look, it's not really worth it, let's just leave it in and we'll you can still adjust the purchase price for it, but we're buying it on a debt-free, cash-free basis. Okay, so that's net debt and cash, why we'd adjust for that. So the next item that we want to talk about is working capital. So first of all, what is working capital? Working capital, and we'll touch on this in significant detail once we go through the technical accounting sections of this course, talking about all the different, IFRS and tax and management accounting, etc. We'll touch on all of this so you get a really good understanding of the fundamentals. But at a very high level, what working capital is, it's like the lifeblood of the business. If you think about it, think about a business like a car. A car needs fuel in it to operate. So let's say you go and hire a car from Hertz or Avis, right? They're not going to, or you buy a car from a car dealer, right? They're not going to give you the car with an empty tank of fuel, right? Even though it's not advantageous for the dealer or the renter to give you gas, because that's a cost for them, but it needs to be in the business to drive that business. So working capital is exactly the same. It's the cash in the business required to maintain it. For example, you might need to have a certain level of inventory tied up in the business, or you might have a certain level of accounts payable or accounts receivable tied up in the business, which you just can't exit from because you need it. If you take it out, the business would suffer or even become potentially bankrupt, right? Because if you can't pay your debtors, they could then, they might claim some of the assets, and the business is in trouble as a result of that. So how the working capital adjustment works is it doesn't work the same as net debt cash, where you just calculate the value of the working capital and adjust for that. What you do is you do some analysis. You typically do this in FDD, like financial due diligence, and you calculate Okay, for this business, obviously working capital can go up and down, but what is the normal level of working capital? What does this business require, on an average month, or the average rolling for the last 3 to 6 months? That's your average. So that's assumed to be incorporated as part of the purchase price. So if we're paying $100 million for this business, we're assuming that there is some working capital that comes with the business. Just like when you buy a car for $50,000, you're assuming it's going to come with a relatively full petrol tank or gas tank, right? It doesn't need to be completely full, but enough for you to drive out, go home, drive around, right? Same principle with working capital. We figure out what the minimum amount is, the maximum amount is, and the average amount is, and it depends on the transaction and what you've agreed, but typically you identify what the normal working capital amount is, and then once the deal actually settles, we then do another analysis. It's called part of the completion accounts. We look at the working capital of the business as at settlement, and we calculate what the working capital, and if it is above materially the normal net working capital amount or below materially the net working capital amount, there is typically an adjustment for the difference between the agreed normal amount and what it actually is. And the reason is you don't want the sellers of the business, in between the process where you're negotiating it, starting to extract as much cash from the business as possible, like pulling out accounts receivable, pulling out cash that's required from the business, right? Because the business needs that. So, and this stops them from doing that because then they leave it in the business, what the business requires to operate. So that's what we adjust for in the working capital price adjustment. So it's not the entire working capital amount, it's just the difference between what it is at completion, or when it settles, I should say, versus what it was agreed as the normal or required amount of working capital. And then finally, Capex, which is a bit less common. But basically, if the business has a very large capital requirement, for example, you might have a large fit out that needs to be undertaken. It can be argued that that should also be adjusted off the purchase price as well, because it's not part of working capital. It's a large one-off adjustment that if we had just waited a little bit longer, the purchase price of the business would have been reduced because they would have had less cash, which they would have used to pay for it anyway. Right? So it's just essentially to adjust for that. So that's the second part of this. So let's go through an example. Same situation where you got 10 million EBITDA times 10 times multiple, so you get $100 million headline price. The business then has, let's say they've got 20 million of debt and 10 million of cash. So what we'll do is we'll take off 20 million for the net debt off the purchase price. We're now at 80 million. And then we'll add 10 million for the cash retained in the business. So it's $90 million, right? So that's what we're paying for the business. And we've agreed that the average or required working capital of the business is, let's say, $5 million, which is assumed to be part of that headline purchase price. Then once we actually settle the business, we find out that the business only has $4 million in working capital. So we're actually there's a $1 million reimbursement that the seller also has to kind of reimburse back to the purchaser. So essentially what that looks like is we're now at $90 million. We're going to get a $1 million credit. So we're essentially going to bring the purchase price to $89 million, but obviously subject to all the terms of your sale and purchase agreement, or SPA. Now, finally, these other matters. Now, these are only if something occurs, and it's typically in the space of indemnities and warranties. And we'll touch on this a little bit later. But essentially what this means is, let's say you do your due diligence, no issues, and the vendor hasn't really disclosed any issues, right? Then down the track, let's say in 1 to 2 years' time after you've bought the business, we find out that there's a huge liability that we didn't know and the vendor didn't disclose, and the purchaser has to pay for it because we bought the business, it was a share sale, we've inherited those liabilities. We can actually claim, or we might be able to claim some of those under the indemnities and warranties in the sale agreement. What this does is it actually protects the buyer from things like, bad faith, not disclosing, fraud, things like that. Anything that you've due diligenced and you've understood the risk of, let's say you've identified a tax liability and you haven't adjusted it up here, you're not going to be protected in the indemnities and warranties because you already knew about it when you bought the business. This is really just to protect things that you didn't really know about and the vendor didn't really disclose to you. So you might be able to adjust your purchase price for that, but it's really just going to cover any out-of-pocket expense or cost that the purchaser has. You can also take out, or the seller and buyer can also take out indemnity and warranty insurance, which instead of claiming against the seller, you can just go to your insurance agency and actually just claim that against the insurance. So these ones is not typically part of your average transaction. But the first two categories, so your headline price and your price adjustment. So your headline price, net debt, and cash, and your working capital adjustments are typically in every large transaction adjustment. The other items, it really depends on the acquisition. So that's how we calculate purchase price and how we calculate the final amount that we actually pay. Net debt and cash is typically done on the date that the deal completes, although there's some transactions where that's not really possible. Like if you're buying a public company and taking it private, you might actually have to do what's called a locked box transaction, which is essentially doing it based off a current date, and then regardless of what happens on completion date, you just have to accept it because you're buying it from essentially millions of different shareholders. You're not going to be able to claim from those after the fact. But for most private transactions, you'll do an adjustment, or you'll do another set of balance sheet accounts on the date of settlement, or as close to it as possible, and then do these calculations for net debt and cash working capital at that point in time. Okay, so let's talk about the next thing, which is comps analysis. So this is essentially going back to this first slide, answering the question of how do we get this multiple over here, right? So we said in an example, I gave you a business which had 10 million of sustainable EBITDA and 10 times multiple on EBITDA. But how do we know that that multiple is 10 times, right? We know this from doing comps analysis. So what is comps analysis? It's essentially looking at precedence transactions and comparable transactions, which is where the comps comes from. So it's basically looking at a bunch of similar companies. So you look at companies in the same industry, of similar size, of similar growth patterns and life cycles and markets, geography, whether they're public, private. So you're trying to get basically as many similar companies as the one you're trying to buy as you can. Now, there's no such thing as a perfectly comparable company, right? Just like when you're trying to sell a car, right? You can try and find similar models, but there's always going to be some differences, whether it's a different color, different age, whether it's auto or manual, might be convertible versus sedan, diesel versus petrol, number of kilometers, service quality, right? So there are some similarities, like if they're both Holdens or they're both Ferraris or both Fords. But at the end of the day, there's no two cars that are perfectly identical, and that's where this comps analysis really comes in. So you're just trying to find buckets and just acknowledges where the similarities and differences are. And the best comps analysis, so I'll show you an example in a moment, but the best comps analysis are the ones that go beyond just identifying the company, but really giving a lot of flavor as to, as I mentioned, how are they similar, how are they different. So outlining, what business activities does this company do, and flagging if there's any kind of differences which might impact the multiple. For example, one business might have an online presence and one might be retail only. And the one that's online only would attract a higher multiple than the retail presence because that's in higher demand. So it's important to flag that kind of thing, particularly to the board executives, so they don't make a bad decision and assume they're going to get a higher value when they're selling their company, but they fail to take into account, we're not operating in the online space. Maybe we don't have the same, geographical location. Maybe the competitors got prime locations. We've got, more rural locations. Maybe they're a much larger size company because that typically attracts a higher multiple and we're smaller. Or maybe the other company's growing at a much faster profile, or they've got different kind of customer KPIs, especially if you're a tech or cloud SaaS business. Some of the key metrics you want to look at is, customer churn, life cycle, cost of new customer acquisition. So it's kind of looking at those things and thinking big picture and going, okay, are there any things which might be impacting the multiple for this comparable company? So how do we do this in practice? So we typically get a number of buckets, and we might do that by saying, okay, these are the most comparable companies, these are the next most comparable companies, and these are the least comparable companies, but we're putting it in for a comparison anyway, so you can see the full picture. And then how do we kind of average out those outliers and variances? So we typically do that through, we look at an average. So we might take the median and then kind of average out between forward and historical multiples as well. And how do we get this data? So, typically we'll use a service like CapIQ, which is a premium service. You need an expensive subscription to be able to access it. But that's at the EBITDA level, but you can get public information about, for example, price earnings, but typically we want to do this based off multiple different metrics, including EBITDA, which is a bit harder to get from public directories. So you might want to get access to CapIQ if you don't, or maybe your company has access to it that you can use. So let's have a look at an example comps analysis. So in this case, we're going to look at a optical business. So we could do a little bit better, and there's probably a lot of information that you can't actually see on this slide in terms of analyzing, say, well, we've got the growth percentage, so you can kind of see the growth profile of each of these businesses. We've got the country, but it would be good to get a lot more detail kind of about, any other KPIs which might be driving any multiple differences. But as you can see here, we've got a number of publicly listed, in the first instance, comparable companies, and we've got transactions, comparable transactions down the bottom. But let's start off with the public companies, which is often helpful because these are trading at any given time, so you can run these quarterly on a regular basis and see how your kind of company's valued over time, or your target's valued. So in this case, we've got different markets, and we've put a lot of thought into this and said, okay, maybe some of these geographic markets aren't going to be included, or maybe some of these are too retail, so we've excluded some of these because we just want to focus on, say, service-based businesses. Next, we've got the market cap and EV. So market cap is essentially the total, essentially in a public environment, it's essentially the equity value versus EV, which is, or the enterprise value. So I don't think I actually explained that from the previous slide, what the difference was. So it's very simple, really. So headline price, this is your enterprise value, EV. You'll see that term passed around a lot. It's essentially the value before you take into account debt. And once you adjust for net debt in cash, so this item here, so take away B, you get to your equity value. So for a private company, equity value is what you pay for. And in the public market, they call it market cap, but it's essentially the same thing as equity value. It's taking into account the value of debt. So for example, this company, its net debt value would be the difference between those two numbers. So it's important to include EV because it gives you an idea about the size of these companies as well, right? The larger the company is, it might attract a higher multiple, so we need to take that into account, particularly if we're valuing a small company or we're trying to sell a small company. We also need to take into account geography, right? Because there's some markets which, for example, the US, which will pay a higher premium than in, say, for example, the Australian market, which is a lot smaller, maybe lower total addressable market, potentially lower growth rates, and so forth. So in any comps analysis, we typically look at the multiple on a few different bases. So EV/revenue, EV/EBITDA, net debt EBITDA, at the bare minimum, right? So, but you might also look at, for example, EV/EBIT as well. And we'll talk about this in the technical accounting sections about kind of what all the differences between EBIT, EBITDA are, etc. And also, as I mentioned before, it's also important to include some operating KPIs as well, because it just helps you kind of identify, okay, well, investors are willing to pay a high multiple for this company because they're growing at 89% a year, CAGR, right? That's massive growth. If your company's only growing at 5% a year, investors probably won't want to pay such a premium multiple for it. So it is important to take into account. So the final kind of thing to notice here is that, to remove the outliers, and in the first run, what we would do is we'd kind of remove companies which don't really fit or aren't close enough anyway. So there's a lot of thought that goes into that process. But then on top of that, to remove any outliers in this process, we'll also look at the median and mean, and then we'll try and average that over, a next 12 months forecast and last 12 months actual, in case any of that multiple is driven by, for example, acquisitions that might be distorted a little bit. So it's good to take into account both. The idea is just to essentially find the midpoint and eliminate any distortions there. So the second part is also to look at transaction comparables. And this data is a little bit harder to get, and it can be distorted by things like internal normalizations, which companies may not be reporting to the market, and They might not even have to report the numbers at all, or maybe the numbers are just hearsay, right? So we need to take this with a grain of salt, but it is important to get a second view of public versus private transactions. The reason being is there's often a premium in publicly traded companies versus transactions, and the reason is companies which are trading at, say, 20 times on the public market will be incentivized to buy companies for, say, 10 to 15 times, because it actually increases the value to all shareholders. Because if the combined business is trading at 20 times, but they're only paying 10 times for a business down here, they're getting essentially, a 10 times profit on the acquisition almost instantly, and that's called multiple arbitrage. So we do need to take that into account, and also if we're maybe trading as a small business and maybe we're acquiring a business, we only want to value them on this basis and not the basis of a publicly listed company, as that could inflate the multiple. Okay, so the next thing we're going to talk about is kind of what comparable multiple do we use for our valuation. So I mentioned before that EV/EBITDA is the industry standard without knowing necessarily about kind of what industry you're operating and all the size of the company. But it's really important to take into account what industry that it is operating in, if there's any kind of unique aspects to the business or industry that we need to take into account a different multiple for valuation. For example, financial services might be off book value or might be off profit. Or if you're a tech company, it might be off revenue, right? The average company will just be off EBITDA, but you do need to think about this before you go in and value the business. So the other consideration is timing of life cycle. So you can see this as a time axis chart as well. Because the more mature a company is, you'll just revert to this standard EV/EBITDA. But if you're an early company, typically how companies operate is, as you can see, revenue is this top line up here. So it'll typically operate in this kind of J shape from zero, starting off slow into an ascent, and then kind of rapid growth, and then maturity over here. But what happens with expenses is they don't necessarily start off in profit. What they'll do is, if I look at, say, EBITDA, for example, which is your cash flow proxy, it'll often start off in a loss. So think about, your startup tech companies. They haven't quite generated the scale. They're investing money in building the product. They're busy building out teams. They haven't quite got that, scale yet that they can operate and make a profit. And it's the same reason why tech companies are valued on multiple of sales, is because it's assumed that, whilst they're spending money on acquiring customers, they're not really going to show a profit. But eventually, once that company hits high level of revenue, high level of market penetration, then they're no longer investing in customer acquisition. They can start focusing on, they've got that scale as well, but they can start cutting on costs and scaling that size as well. And all of a sudden, their EBITDA starts scaling quite rapidly. So does their EBIT, so does their net income. But there is that delayed time factor, which is, why you might want to consider the life cycle of the company as to which kind of multiple you use for your comparable valuation measure. Now, the next few slides, just to finish off this chapter 2, is kind of what are the pros and cons for each of those different kind of valuation methods. So we've got 4 examples here. We've got EV sales or EV revenue, same thing. So it's a multiple of your revenue. We've got EV/EBITDA, which is your, the standard one that most companies use. EV/EBIT. So the difference between EBITDA and EBIT. So EBITDA is earnings before interest, tax, depreciation, amortization, whereas EBIT is earnings before interest, tax. So you can see the difference is depreciation and amortization. So this, you could get a very different result for a very capital intensive industry, for example, car manufacturing, because they might show quite a high EBITDA, but the fact they've got huge depreciation, which is a non-cash expense, of course, right? It's not going to impact their cash flow, but it's still something to take into account, because eventually you're going to have to replace that equipment, right? Which is why we have depreciation at all. It's a reflection of the life expectancy of the asset, essentially, and when we need to kind of outlay a large capital outflow in future. So if you're operating in that kind of field with heavy capital intensive industry, you might want to use EBIT instead of EBITDA, better measure. And then finally, you've got price earnings. So what is earnings? It's a little bit misleading. Earnings is actually net profit, right? And net profit is very easy to get, because you can go to Google and look up the price earnings of a company very easily. In fact, I'm going to do that very quickly. Now let's Google, let's go zero price earnings. Actually, I'm just going to go zero stock. And it is going to show up it's going to show up. Just a little bit of a high level recap. You can see the price earnings ratio, and this is insane because it's a tech company and they haven't, probably for the same reason we discussed before, they're in that ramp mode, right? So they're in that ramp mode maybe over here where the revenue is scaling very rapidly, but they're not yet in profit. So 0 is probably about here, right? Because they've still got a little bit of profit, but they're not quite at that high level of maturity, right? So, price earnings is very easy to get, but the problem is it's quite misleading, right? Because it's got a whole bunch of accounting policies in there and a whole bunch of non-cash items. So, okay, let's go through these one by one. So the first one, EV sales. What are the pros? Well, it's suitable for companies with similar business model development stage, so good for early companies. Maybe the only performance-related multiple available for companies with negative EBITDA. So as I mentioned, a lot of tech companies are going to be negative EBITDAs. They're not really making a profit yet, so how else do you value the business? You can do a future cash flow, but it's kind of hard to estimate and, but revenue doesn't lie, especially historical revenue. So if you do a multiple of that, it's a good way of kind of comparing it. Sectors where operating margins are broadly similar between companies, you can kind of make an estimate on that basis. Companies whose profits have collapsed might be a temporary thing like COVID, for example, and you don't really have any EBITDA to show for it. So the alternative to doing that is you just take an average of the last 3 years EBITDA and do it on that basis. Next is sectors where market share is important, right? And maybe it's more about gaining market share in the short term, and then you can kind of, once you got that monopoly, you can force out competitors. Limited exposure to accounting differences. Cons, does not take into account varying revenue growth rates, right? So it's important. That's why we did the comps analysis, right? Because we look at those other measures like revenue growth, where you pay a higher multiple for high revenue growth, because in 3 years' time, your company is going to be worth a lot more money. And a lot of costs kind of scale down with growth, which means you actually get profit at large scale, which you might not get at a small scale. Another con, it does not address the quality of revenue. You do that in DD. What is quality of revenue? So it's like recurring revenue. You don't want it too concentrated either, right? If you've got it in a couple of clients and you lose a client, well, there goes all your revenue. You want it to be recurring. So if it's a short-term contract for your revenue, like a 6-month contract or 2-year contract, that's not good, because you buy the business 2 years, there goes your revenue again. So it's looking at things like that. Does not address profitability issues, right? I think this one's really probably the most important point out of all of these. And I think whilst the principle is true that, especially for companies that do scale and, EBITDA is not necessarily the best measure quite yet, but I think that's gone a little bit too far, a little bit excessive, especially lately. If you look at companies like Tesla, they're getting to a mature stage. They've been around for 15 years now. They're at a mature stage and they are just absolutely hemorrhaging cash. So let's just quickly look at Tesla's price earnings. Like at the end of the day, at some point in future, you're going to need profits for the business. Otherwise, why would you own the company, right? You can accept it for a short amount of time because you're expecting revenues to grow in future and then receive profits in future. But if you're never going to receive profits, why are you investing in this company? And I think some people are forgetting about this. And look at this, 400 price earnings. That means essentially if earnings stay the same, you're essentially not going to get your money back from dividends for 400 years. But that's before taking into account tax, which is just insane, right? So just keep that in mind. And different revenue recognition rules between companies. Okay, and then let's go to EBITDA. What are the pros and cons? And as I mentioned before, this is the baseline in industry and finance. If you're not sure which multiple to use, just rely on EBITDA because there's a high chance it is going to be the right one. So it incorporates profitability. So really important. Revenue is important, but so is your cost base, right? Because if you're losing money, you're going to go out of business, right? So your cost structure is important as well, and your profitability is important. Number 2, most businesses are EBITDA positive, so it widens the universe. Number 3, ignores the most significant accounting differences arising from goodwill. So you might have some other accounting adjustments which are below EBITDA level, like in net profit. For example, depreciation is a non-cash expense. So you could be a very profitable business bringing a lot of cash, but it's not reflected in earnings because of depreciation, right? And that's just one example. There are many other examples which could affect it as well. Number 4, relatively limited exposure to accounting differences. So EBITDA is not perfect, but it's not bad. Like, that's why it's universally used, is because it can be used to compare most companies fairly well, and it is an okay proxy for cash before tax. Not in all situations, but it does give a better indicator than net profit and EBIT for what your cash flow from the business, which is super important. Warren Buffett says cash is king, and it is true, because if you get a feel as to kind of how much profit can be distorted by accounting variances, which we'll really get into in the later accounting and financial reporting section of this course, you'll see why it's so important. And now the downside. So it ignores depreciation capex. So I mentioned before, especially if you're in a capital intensive industry, depreciation, whilst not a cash flow, it can be important over time, because it's kind of like building up a buffer as your asset depreciates. That's a cost, but if you put that aside, it's kind of like we're expecting to put that towards our reinvestment in the asset in 5 years time or 10 years time, whatever the effective life is. It's reflected on the accounts, right? And then in 10 years time, you spend $1 million on getting a new asset. At least you've been reflecting that over the past 10 years, whereas with EBITDA, you're not really reflecting that. Number 2, ignores tax regimes and tax profiles. Look, I think the reason why we do this, excluding tax, is because some businesses have different tax profiles. Like some might have carry forward losses. Some might have international tax arrangements, like Apple, where they're only paying 8% overseas versus 30% in an Australian company. Right, so it is important to kind of, and by removing that, you've now got this universal measure which can be easily compared against almost any company in the world, regardless of where it's located, regardless of what it does. That's why we do it, but you do need to remember the tax cost is after EBITDA as well. It does not take into account varying EBITDA growth rates. Well, yeah, that's why we do the comps analysis and add in those extra data points so we can compare those as well. Inconsistency of treatment within EBITDA of joint ventures and other unconsolidated affiliates within different reporting environments. So we'll touch on this in our technical accounting section in the course later on. And other accounting differences such as revenue recognition, capitalization policies, finance versus operating leases. So yeah, I did mention that, we do need to be wary of what are the accounting impacts on EBITDA. So one example which I'll draw your attention to is capitalization policies. So tech companies in particular, they can sometimes capitalize expenses either for R&D or maybe labor on building their product. And that's actually, some of them do it quite aggressively. So some of them actually hide their true expenses. So something to be careful there. Another one to be careful of, which is quite a recent issue, which didn't used to be an issue, is the IFRS 16 leases issue. And yeah, we'll touch on that in the financial reporting videos, but a really important one to understand, because it used to be that EBITDA would include lease expense. That would be fine. The cash that you pay for your lease, especially if you're a retail heavy environment, it would be reflected in your EBITDA. But now with this new IFRS 16, it actually forces you to take out your lease expense below the line and treat most of it as amortization, which is below EBITDA. So, what's the impact of that? It's going to impact multiples paid for businesses, really, because it's going to inflate EBITDA, it's going to reduce multiple, or it's going to trick people into paying a higher price for businesses than they would have otherwise. So just something to be really careful of as well. And then finally, EBIT. So quite similar to EBITDA, the only difference is depreciation and amortization. So the benefit of using EBIT is, well, at least it takes into account depreciation, and also now it mitigates that IFRS 16 issue. So potentially EBIT over the next few years is going to gain a bit more kind of commonplace to use, just because it does kind of address some of those issues. But depreciation at the end of the day, it's not a cash item, so just be careful with that one. We really want to know what's the cash position and cash generation of a business, right? So depreciation can distort that. And then finally, price earnings. I mean, it's very easy to get this data, as I showed you, got that in 2 seconds, but getting the EBITDA is a little bit trickier and also a bit subjective as well. But the issue with using price earnings is, well, there's so many accounting policy impacts on it that there's sometimes just a very big disconnect between cash flow and price earnings. So I use it as a very, very high level indicator of a company's valuation, but to me, I try and stay away from it. and I try and calculate what the EBITDA is myself and value it on that basis instead. Okay, so that's the end of chapter 2. In the next video, we'll cover off EBITDA and underlying earnings and why it's so important to really understand what EBITDA is and how do we calculate underlying earnings. So thanks for watching. I'll see you in the next video.